In a recent interview, the founder of Motilal Oswal, Mr.Ramdeo Agrawal, talked about India's new age tech sector. He said this sector is going to produce true multibaggers in the near future. For some of the companies from this sector, a compounded annual growth of 40 to 50% looks to be at the lower end of the growth limit, according to Mr. Agrawal. It is relevant to understand that a CAGR of 45% over a period of 10 years can transform an investment of 10 lakh rupees into 4.1 crore rupees. If you want to know more about these potential multibaggers, please keep watching this video till the end. Also consider subscribing to this channel because that will really help me keep making more videos like this one. Namaste and welcome to Retail Investing. If we look at the top companies of the United States of America based on their market cap, we will find that all of those are tech companies with the exception of Berkshire Hathaway. If we compare that to the largest Indian companies, we will notice that there is not a single tech company. TCS and Infosys are on the list, but they are not exactly tech companies. They are service companies. Now we are living in an age of technology, and if India is going to continue as the world's fastest growing economy, technology has to play a major role. These Indian tech companies that Mr. Ramdeo Agrawal was talking about are very much different from their American counterparts. Companies like Apple, Google, and Nvidia have to spend huge amounts of money on research and development to stay relevant. If these companies cannot outspend their competitors, they will be replaced. The Indian new age companies are much simpler businesses which do not depend on heavy R&D but are powered by the internet revolution in the country. According to a report by Red Seer, by 2025, there will be 100 crore internet users in India and 40 crore online shoppers. The exciting part is that most of the future growth is going to come from the tier 2 cities. Cities like Chandigarh, Jaipur and Lucknow. This will help businesses to achieve pan-India growth. Guys, I totally forgot to tell you the name of the companies. Mr. Agrawal was talking about Paytm, Policybazaar, also known as PB Fintech, and Nykaa. Now these businesses not only do not need to invest heavily into research and development, but also don't have to buy a lot of heavy assets like plant and machinery. When companies buy a lot of heavy assets like plant and machinery, they usually take on a lot of debt, which requires a lot of interest payments, plus every year those assets depreciate. Due to competition from other players, there will be constant pressure of upgrading the machinery, which will require even more capital. What about those businesses which do not require heavy assets and can still generate good returns on capital? They have a different kind of risk associated with them. Competition. If one company finds such a business model which can generate very good returns on capital without buying heavy assets, soon hundreds of other companies will enter that business because not much capital is required to start the business and there are no entry barriers. If heavy investment is required to start a business, that itself becomes an entry barrier. Now this is the reason why companies like Reliance Industries and the Adani Group of Industries have no competitors. However, the best kinds of businesses would be the ones which do not require heavy assets and still have a durable competitive advantage, which is also called a moat. A patent can be a very good moat, but it happens very rarely that a company develops a product or service with mass appeal and gets a patent for it, so that no other company is allowed to develop the same. The best moat is a brand and the brand value. A brand is something which creates a distinct identity in the perception of consumers. The word to focus on is perception. There is a big difference between perception and reality. Perception is the way an individual thinks, or in this case, made to think by a company. So perception is what is inside our heads or put into our heads. Reality is what is outside our heads. Take Apple for example, which is the world's largest company in terms of market capitalization. In reality, the Apple logo is just a piece of aluminium cut out in a certain way. It does not even cost that much to create that logo. But in the perception of consumers, that logo is so much valuable that millions of people are crazy for it. Even as a fan of Android, whenever someone says premium smartphone, the first thing that comes to my mind is an iPhone Ultra Pro Max or something like that. Now this is called having a piece of the consumer's mind. People do not even think for a minute to take credit card debt at interest rates of over 30% to buy a piece of Apple. In most cases, Android phones are much more versatile and useful than Apple phones. But Androids have not built a brand like Apple has. And that is the reason Apple is valued at $3 trillion and no Android company is anywhere close. Out of the three companies mentioned by Mr. Ramdeo Agrawal, to me, it seems like Nike is building the most powerful brand and hence the strongest moat. Nike seems to be in the initial phases of having a piece of the consumer's mind. Plus, out of the three companies, only Nike is already profitable. So Nike's business is mainly in the online beauty and personal care segment. The beauty and personal care market in India grew at a CAGR of 60% in between 2016 and 2020. And in the next 5 years, the market is expected to grow at a CAGR of more than 35%. This is some incredible growth. To me, it looks much more promising than hot sectors like the EV sector and the AI sector. I will probably stay away from the AI sector because it is highly unpredictable. When I visit the Nike website, even as a man who has no interest in beauty products, I can see successful pull marketing as opposed to push marketing. In push marketing, products and services are constantly pushed towards customers. I am sure you receive a lot of those annoying calls regarding loans. In pull marketing, consumers naturally get attracted towards the products they love. It happens when there is a perception of a premium brand among the consumers. Now in the real world, I have seen the craze among the ladies to do shopping on Nike. I have seen ladies from all ages set reminders on their phones to do shopping on Nike because products get sold out within minutes after a deal starts. When I look at another company which deals with beauty products, Mama Earth, Nike's competitive advantage becomes clear to me. Mama Earth has to constantly push its products to consumers by heavy social media marketing and still cannot generate profits. Now, if you look at Nike's profit and loss statements, you can clearly see that their sales have gone up 10x in just 5 years and the company is already profitable since 2021. One thing that I notice is that the depreciation amount is constantly going up. I mean, when depreciation is so high, it usually means that heavy expenses are going to happen in the future because the company might need to acquire new assets to replace the old ones which have depreciated. Now, if you look into the cash flow statement, you will notice that the company is having some problem with its inventory. As per my understanding, one thing that Nike is doing wrong is that it is dealing with too many products. I mean, it has a health and wellness segment also, it has a men's segment also, and there is also an appliances section. I don't think it is a great idea to have so many verticals. Now, if you look at this financial snapshot, you will notice that Nike is trading at a PE ratio of more than 2000. This looks absurd. I mean, why would anybody buy such an overvalued company? Now, the PE ratio is arrived at by dividing the price of one share by per share earnings, which is also called EPS. Now, when a company just becomes profitable from previously being a loss-making company, its EPS is usually very low. I mean, it's barely positive. Now, if you divide the price of the share, which is 149, by the EPS, which is a very small number as of now, you will get a very high figure of above 2000. I don't think there is anything to worry about this figure, because when the EPS will keep growing, which it has already started to grow, PE ratio will come down very fast. If we look at Policy Bazaar, also known as PB FinTech, very interesting things have already happened. This is the profit and loss statement of Policy Bazaar. The company had a per share loss of more than 91,000 rupees in 2019, and today the number is only 10. This kind of increase in profitability in such a small time is unheard of. In many interviews, I am hearing a lot of big investors like Mr. Saurabh Mukherjee saying, yeah, we are watching Nike very closely, but not yet buying. Well, they are not going to inform retail investors before they start buying. They suddenly buy and stocks skyrocket. If you look into the chart of Policy Bazaar, it looks like some big players have already entered. Out of these three stocks, I'm going to start accumulating Nykaa very soon, mainly because of its superior brand value and profitability. Since Nykaa is the market leader in the beauty and personal care segment, and the beauty and personal care market itself is going to grow at a CAGR of 35% in the next 5 years, I think Nykaa can definitely grow at 35% CAGR. So it looks like a big multi-bagger to me. Now do not consider this as an investment advice. This video was only for educational purposes. Don't forget to type in the comment section which of these stocks do you like the most. In my case, Nykaa is at number 1, PB Fintech is at number 2, and Paytm is a distant third. I hope I was able to share something valuable in this video, and thank you very much for watching. Have a nice day and I'll see you soon.